All right. Thank you for tuning into the Equity Channel, where we provide the highest quality stock market analysis to individual investors. Our goal is to help you improve your returns while keeping you up to date with everything that you need to know. What helps investors beat the market is information and knowledge of how to use it, and we will provide you with both. Before we get started, be sure that you subscribe and turn on your notifications because every time we drop a new episode, money is made. Okay. Um, Value Investing 101, yet another night of great learning, great education. Tonight, we're going to be talking about what makes a stock a strong buy. All right. Now, here's the thing. What I really want to be answering tonight is the question more so what gives us the audacity to think that we can suggest a stock is a strong buy? What gives us the ability to say that? Right? When we're operating in the market, there's a certain amount of participants out there who are going to believe something different. There are a certain amount of participants out there who will agree. To us, it does not matter whether they agree or disagree. We are dealing with what we established in our last session as objective investment quality. So therefore, we are not inserting our opinion into the matter. This is strictly by the numbers, right? We're taking the numbers behind the business, right? And we're putting together what's known as a 9-point investment grade. It's a 9-point system. And we're utilizing that to identify companies that we believe are strong enough that if we buy them, it will not result in a major loss of capital. And this, if we're taking the humble route of saying, and we always do take the humble route of stating, um, we're talking more often than not. We're talking the greater percentage of the time. Like earlier today, when we ran our analysis, we found that 76% of our investments, right, are profitable over the past 1 year, right? So these companies that are rated a buy or a strong buy that we end up investing in are working out nearly 80% of the time. Nearly 8 out of 10 investments are working out. So tonight, we're going to talk about why. We're going to talk about why they're working out. Here we go. So the 9-point investment grade. It's about the numbers, like I said, right? Not the hype. All right. It's an objective audit of a company. And by that, what I mean is you show me a business. I don't say, I don't think I like the owner, or I don't think I like, the color of the painting on the walls and yada yada yada. What I go after, right out the gate, show me the numbers. I walk to the business and I say, show me your books. right? You show me your books, and that will show me our future prospect of doing business together. All right. Now, this is the true fundamental health of the company. A strong buy is not a guess. It's a you know it's a mathematically proven grade earned only by businesses of the absolute highest operational and balance sheet quality. All right, we have 9 core pillars. And what I did tonight was I put them into groups. Put them into groups. Okay. Group one is the efficiency group. Return on invested capital and price to free cash flow. Now, this is also known as the magic formula. No joke, it's really called the magic formula. Right. Um, it was first written in a book by Joel Greenblatt called The Little Book That Beats the Market. And later on down the line, I was able to make some slight changes to the formula in order to make it more reliable. And one of the things that I did was I replaced earnings yield with free cash flow yield. Why did I do that? I did that because earnings, as it pertains to the stock market, can be manipulated. Not every company manipulates their earnings, but every company does take advantage of the system that is in place. And that system allows companies to essentially report earnings before they even get the earnings. So some of you guys work in, the corporate world, or, even it's not in corporate world, you work in industrials or whatever it is. So you've seen the invoicing process, right? Even if you work, let's say you worked for a construction company, right? You've seen, your foreman or your boss write up a bill ahead of time and slide it to the customer and say, you know, sign right here if you agree, and the customer signs, check. But you guys won't be starting that work maybe for, maybe for a month, or, a week, you know. Either way, the work was already approved by the client. And so in the stock market, your boss would be able to claim those earnings before they got even a penny of that cash. Okay. Now, how far ahead of time somebody books these earnings is what's going to matter in the end, right? Typically, you want to see companies that are booking earnings less than 90 days ahead of time, which means that by the time the quarter ends, they would have already collected all that cash, right? So let's say your boss books those earnings within 90 days, right? Um, then great. That's great, right? Now, we'll talk more about that in a second. The second group that I put together is the momentum group. This is the Petrosky F score and the price to book. Now, this is what we call fundamental momentum, right? The F score. Or we can look at it as business acceleration. Now, these two go hand in hand, and you'll see the price to book being utilized at other points under valuations. You'll see them there as well. But in the end, here with the Petrosky F score, this is another system within the system that when these two metrics are combined, right, they create a similar effect as the magic formula, whereas a high Petrosky F score and a low price to book tend to mean that the company is going to you know they could be in the midst of a recovery or a turnaround, right? Because a low price to book more often than not signifies that the company's out of favor. But then the high F score, in essence, suggests that the fundamentals are turning around before the valuation actually does. All right. So before people even recognize, you may be catching on to a winner. The third group, and I'll be explaining these metrics in more detail as we go to analyze a few companies. Okay. The next group we have here is the um, earnings and revenue growth. Now, for this particular group, right, this growth group, um, we're aligning, we're looking at this and saying, is the business growing? And is the company generating a profit on paper, which is enough to start to attract institutional capital, right? Institutions aren't crazy enough you know, to bet on everything, that hits the market. They look for specific types of companies, and these types of companies um, have these metrics that we're talking about to the T. All right. Now, next is the valuation group. It's headed up by price to earnings growth, but at the same time, even though your price to book and your price to free cash flow are already connected to two other groups, if you can have all three of these connect and give you a sign that the company is undervalued, that's the best case scenario. But on the valuations, we're looking for pricing that growth. Like, how does that growth price in terms of, the expectations? And last but not least, we have the safety group. This is earnings quality and debt to free cash flow. All right. And earnings quality, it goes right back to what I said earlier when I said, hey, your boss may book those earnings ahead of time, right? Earnings quality is essentially letting us know what percentage of those earnings at the end of that period ended up being backed by cash. Okay, that's what it lets you know. What percentage of those earnings at the end of that period ended up being backed by cash? All right, let's keep going. Now, again, if you're on Clubhouse and you're joining us for the first time, you click that link at the top of the room and you'll see it says watch us on Twitch. Come on over, check us out. All right, now let's talk about the magic formula where quality meets value. When it comes down to capital efficiency, return on invested capital is the ultimate measure of a moat or a competitive advantage. Right. So we have legendary investors like Warren Buffett who prioritize this particular metric, right, above almost everything else. Measures how how efficiently a company turns that capital into pure cash profit. Right? So a high consistent return on invested capital, mathematically, it proves that the business possesses a competitive advantage or a moat, and exceptionally capable capital allocators are running the business, right? Then we have the valuation based on real cash flows. Now, what I've found is that of all metrics, right, we can line them all up, right? Price to book, price to earnings growth, price to operating cash flow, line them all up, right? And price to free cash flow and earnings yield. These two metrics tend to outperform everything else. So let's say I took a company that was the lowest in its group for price to earnings, a company that was lowest in its group for price to sales, and a company that was lowest in its group for price to free cash flow. Let's say I took that, right? Well, what I end up finding out is that the price to free cash flow, the one that had the lowest price to free cash flow, right, is the one that tends to outperform. Now let me break down these ratios for you guys. This price to this, price to that, price to this. Let me break that down for you so that it's understood. When we say price to free cash flow, what we're saying is, right, for every $1 of free cash flow, and free cash flow is like actual earnings or profits in cash. That's it. Think of it just like that. Actual earnings or profits in cash. After the company has spent all the cash it needs to spend, right? How much cash is left over? You see? So, for every dollar of that cash, how much money am I giving up to buy the stock? So, if the company had $1 of free cash flow and the stock was trading for $1, right? Then I would be buying the stock at a price of free cash flow of a 1, right? If they had $1 in free cash flow per share and I was buying the stock at $10 per share, then the price of free cash flow would be a 10. Okay? The lower that number, the more likely it is that you're dealing with an undervalued business. Notice I put a lot of stress on the more likely it is. That's why our process is so important. We don't allow any one metric to tell us what's what. We measure this out across multiple things. All right. So the magic formula is pretty simple. A high return on invested capital with a low price to free cash flow. When those two things come together, my goodness, it is a wonderful combination. I repeat, that is high return on invested capital, or they call it ROIC, high ROIC with low price to free cash flow. And voila, you got you something. How do you know when a return on invested capital is high? Well, you can measure that against the competitors of that business, or you can measure that against the actual costs that the business is incurring, right? However you want to do that. Okay. Most people measure it against the competitors, but if you learn how to calculate the cost of equity or the cost of capital, and you measure the return on invested capital against that, that will work really well as also. Okay. How do you know if a price of free cash flow is low? You can look at this versus either the competitors yet again, or the average competitors in the sector or the industry. Or you can look at the historical price to free cash flow of the company. If historically over the past 10 years, the price to free cash flow of the company was a 25, but today it's a 15, well, historically, this is a low price to free cash flow for the company, right? Especially if the lowest of the low is in proximity, right? It may not be as low if the lowest was 5, right? But it's still low nonetheless because it's below the average. Okay, moving on. Momentum and asset value. The Petrosky F score, right, was a way of spotting financial turnarounds when you combine it with the price to book. So price to book is going to be the same as price to free cash flow, except when we talk about book value, we're talking about equity. We're talking about the net worth of the company. So if we say the company is worth $1 in assets, then if we pay $1 for the stock, we have a 1 to 1 price to book. Okay. Now, same goes for the situation over here. You want a low price to book and a high Petrosky F score, right? A lot of times we're looking for an F score of a 7 to 9. That's what we're looking for a lot of times. All right. And 9 is the highest you can get. Now, I set my initial threshold at a 6. That's my initial threshold for the price to my initial threshold for the price to for the Petrosky F score, I meant to say, right, is a 6. Right. And I pair that up with a low price to book to see if I can find quality at a reasonable price. All right. And quality that's trending higher, that's a momentum to the upside. Right. So it's what the Petrosky F score does is it looks at the company this year versus the company last year. And it has 9 components to determine if it's getting better than last year or worse than last year. That's it in a nutshell. Now, there are a few components like just is the company positive free cash flow? That's not about last year, but in essence, it always can be because what if the company was negative free cash flow last year? Now they're positive this year. That's a great sign. Okay. All right. Next, we have business growth. All right. In the case of business growth, um, we have this top line situation with revenue, bottom line with earnings growth. Right. The top line is the literal growth of the business. Right. The earnings growth is the more hard line efficiency of the business. Right. So in essence, you're really saying, from a productive standpoint, how much does the company actually get done with what they have? That's your sales growth. Right. As it says here, the ultimate indicator of demand. It proves that a company is successfully capturing market share and expanding its customer base or commanding substantial pricing power. Okay. It's hard for a business to compound wealth if their sales are not growing. Right. On the earnings growth side of things, what you really want to see there, you want to see a company that's consistently growing at a steady pace. You're going to see spikes in growth sometimes here and there. It's important to identify when that's just a spike and when it's not. But Here's the real secret behind looking for earnings growth. This helps us align with the S&P 500. If a company's already profitable, right? Major players like the S&P 500 are looking for these companies in order to index them and, keep those as a part of the index so that way they can keep the market moving forward, right? So verbatim, profitable companies keep the market moving. If all of a sudden every company was unprofitable, I can assure you the market would go nowhere. That much I can promise you. So we align ourselves with the companies that the market is likely to want to utilize to keep things pushing. All right? Okay. Now, talk about the price of quality. Like I said, we're looking for quality at a reasonable price. All right? A price to book was popularized by Benjamin Graham. Price to earnings growth was popularized by Peter Lynch. Right? Price to free cash flow. It kind of just is what it is. It's that real world hard cash. All right. So not only are we taking systems and building them within systems, we have some of the top investors that ever lived that back these metrics with every fiber in their being. Okay? If you look up price to earnings growth, you will likely find many mentions of Peter Lynch. All right? If you look up value investing in general, you're likely to find many mentions of Benjamin Graham. And if you dig into Benjamin Graham, you will find that price to book was his main metric. The next thing we have here, oh, I'm sorry, and let me point this out as well, real quick here. What we use these metrics for, we use these metrics to determine if we're overpaying or stop. So if I can get at least 2 out of these 3 to be as low as I need them to be, then that'll prove that we might be looking at a discount here. The final verdict is to actually analyze the value of the company, but this is always going to be a good start. All right. Quality and financial solvency. These are the last final pieces of the puzzle. When it comes down to earnings quality, it's income versus free cash flow. So true earnings quality measures the direct divergence between reported net income and actual free cash flow. A high quality grade guarantees proper profits. Paper profits are fully backed by physical liquidity. Right? The company claims massive profits but lacks matching cash flows. Our framework flags it immediately. Right? It's giving you an airtight guard against accounting distortion and corporate shell games. So, the question I said I would be answering for you guys tonight is, well, what makes us capable of saying any company is a strong buy? And maybe, just maybe, as you've been listening and tuned in to what these metrics we use are all about, you can see how when you combine them all together, it's very hard to buy a bad business. It's very hard to buy a bad business when you have these things, right, playing out here. Now, your debt to free cash flow, it pairs up with this earnings quality in order to give us one final bit of understanding. By this time, we already know if the company is efficient or not. We already know if their valuations are solid or not. We already know if their earnings are quality, if the company is growing, the business is growing. All right. We already know if their company is improving from last year into this year. Is it getting better or worse? We already know all these things. And now, last but not least, we ask ourselves, okay, if they are making all this money, can they keep it? Or do they have to continue to pay all that out in cash because they have too much debt on their hands? So this is called debt to free cash flow. So similar to price to free cash flow, we just replace price with debt. So for every $1 of free cash flow, how much debt do we have? Pretty simple. All right. And my standard is we want to have at least $5 in free cash flow for every $1 in debt. Okay. And that, would suggest that we have enough free cash flow to cover an entire business cycle, 5 years. Okay. Let's keep going here. Let's go over to the last portion here. All right. Let's talk about how it all comes together. This system is going to leave you with no blind spots. Leave you with no blind spots. All right. It is a complete risk filtration system. Cheap stocks are checked for growth. The fast growth is checked for cash quality. High earnings are checked for debt solvency. And so by combining these 5 lenses, we systematically eliminate value traps, debt bombs, and accounting failures. Keep a perfect balance, right? Quality and price symmetry. The framework establishes a perfect balance of deep value, setting the floor, and elite business performance, right? Which is like the ROIC and the F score. And so this ensures that you enter high growth situations at a value price, right? Quality at a reasonable price. That's what we do. Objective investment quality. That's what we look for, right? The strong buy in the end, in value investing, confidence is built entirely on verifiable facts right now. So a 9-point strong buy grade is a mathematical proof that a business generates real cash, carries safe debt, accelerates operational momentum, and is deeply priced below intrinsic value. All right, these are going to be all the things that you're looking for. Now, that last one you won't get all the time. You won't get it deeply below intrinsic value. All right, that's not going to happen all the time. But in the end, you will have a lot of companies that are of such good quality that you're able to. These companies are of such good quality that you're able to, invest at or near fair value. See, a margin of safety is like saying, I believe the stock is worth $20 per share, but I want to buy it for $13 to $15 per share. That's what your margin of safety is. It provides a cushion. So if you're wrong about the company in any way, shape, or form, you're allowed to, you know, uh, kind of hold on to that a little longer than you would have if it was already, like if it was already kind of sinking from the jump, right? So buying that margin of safety really helps. Okay. Now, I've had this portfolio loading up in the background here as we spoke. You guys will notice I added a financials, a chopping block for financials here. I figured, you know what? Let's just do it. Let's just do it anyway. All right. So what we're gonna do now is I'm actually going to grade a company and talk a little bit more about these. I'm going to grade a company and talk a little bit more about these metrics. Not going to, not going too much deeper into them because we don't want to, just we don't want to essentially have it to where there's no room for questions in the end, right? So I'm going to grade a company here, and then we will go into everything from there. All right. Let me actually grab the link to our. All right. So here we go. Okay. Let's go ahead and pin this real quick here. Let's go ahead and pin these bad boys right there. Okay. I'm going to use a split view here between the two. All right. So right now I have my index here. 50 companies that are they're currently ungraded. I don't have any grades on these companies right now. You see, every single one of them is listed as a hold with a neutral outlook. Okay, that's like middle of the ground, middle of the pack. All right. So we're gonna start off with Seagate here, STX. We're gonna grade a couple companies here. All right, as I point out how they fit the description of what we're talking about. Now, every company here is not a strong buy. Okay, some companies are just rated a buy. Some are rated a hold. Right, but we look to replace those hold ratings with buys and strong buys over the long run. All right, so you can see here. And look at that, Alicia. You see right there, 716.35 as we discussed. It matches right up, and it gives you what the cost of equity is here. So if you wanted to match that up later with the return on invested capital, you can. You see how that works? So your cost of equity is 25.37%. Your return on invested capital is 69%. So clearly, you're doing well enough in that department. But Seagate is a buy with a favorable outlook, right? Right now, let's just focus on the buy rating. So let's focus on that for a second. What makes us say that Seagate is a buy? Let's talk about it. All right. We have the Petrosky F score of a 7. All right. Now, this Petrosky F score, and for those that are just joining us on Clubhouse, if you click the link at the top of the room, you'll see it says watch us on Twitch. You might want to come on over here and you can see what we're talking about. You can see what we're doing. All right. It's up to you. Now, again, you'll see here that the F score is a 7. However, your price to book is a 211. So at this point, we know that their equity is not priced on the low end. Okay? They have the fundamental momentum. So the F score of a 6 or better says that the company is accelerating. The business is accelerating year over year. That's business acceleration. Okay. Let me show you guys some of the things that we look at for the Petrosky F score. Okay, here we go. All right. Oh, hold on 1 second. All right. So let's have this pull up real quick here. So the Petrosky F score looks and look at the depth, right? That we're going into. We're going into a lot of depth here because we already have metrics that look at profitability in our system, right? The Petrosky F score also looks at profitability, leverage, and operating efficiency. Okay, so the company generated profit in the current year. The business is generating possible returns on its asset base, right? The return on invested capital. The core business operations are generating cash. Okay, these are your cash flow positives and earnings positives that I was talking about, right? Now, look at this. Your operating cash flow must be greater than net income. Okay? The ratio of long-term debt to total assets is lower than the previous year. So in this particular case, it's asking, does the company have more debt or less debt this year relative to the amount of assets that they have, right? So you want to see the company build up more assets and liabilities year over year. So let's say the company added $1,000 in assets, but only added $300 in liabilities. That's awesome. Okay, you see how that represents quality, right? Increased liquidity. The current ratio is higher than the prior year. That's the same as saying that the company's the cash the company has to pay its bills, right, is actually increased faster than the company's bills. That's the same as saying that. So imagine the company has, let's say they had $10,000 in debt last year with, let's say, $12,000 in current assets. These are either cash or things that'll be turning into cash, right? Now from there, let's say this year now they have $11,000 in cash, but they have $15,000 in current assets, which are the assets that either are cash or will be cash within a year. Now that in this regard, that says that your cash assets grew faster than your liabilities. That's always a great thing. Now, you guys can look more into this stuff, on your own time. Like I said, we don't want to stretch it too much. So let's keep going here. Okay. So that's a little bit something of what the F score does. It measures the company as far as its momentum. It measures the company as far as is it accelerating and pushing the best parts of the company are outgrowing the worst parts of the company, right? That's basically what you're looking at. But we love to see that paired with a low price to book, right? So when you don't get that part, that's the part that's a little disappointing. You would love to see that low price to book with the high F score. Right? And F score of a 7 to 9 is considered relatively high. Okay. Now, next we look at the return on invested capital. I'm going to keep this one very simple here. All right. Um, putting a company with a putting a company with a high return on invested capital versus a company with a low return on invested capital is like putting a Ferrari versus a VW Bug. Okay? The company with the high return on invested capital is always likely to outpace the one with low return on invested capital. In fact, it's been proven that if you were to put 100 companies together in a list and you had them sorted out by return on invested capital, the top 25 companies would heavily outperform the bottom 25 companies over the long run. Okay? Over the short run, anything can happen in the stock market. Tomorrow, the worst company can jump by 35 to 50%. But I would love to see them keep that going. Okay? Most times they can't. But the companies that have this high return on invested capital, when they get going, they tend to stay going. Okay? And we like to see that paired up with low price to free cash flow. But you can see here, our price to free cash flow is not, what it is. Now, what I'm using right now, guys, is called the Oracle X. Okay, it's called the Oracle X. You can, in fact, pick up a copy of the Oracle X anytime you want to. Anybody can grab one of these. What it does, it analyzes companies for you. Okay, that's what it does. All right. If you're in the chat on Twitch, I put a link in the chat on Twitch. You'll see it says stock analysis tool. Right. It's at the top of the room on Clubhouse as well. All right. Right here. See, it says stock analysis tool. This is your Oracle X right here. You can pick that up anytime you want. All right. Now, let's get back to this here. Right. So what this does is it stops you from having to do all the work yourself. And I'm going to actually do one company by hand, so you guys can see what that looks like by hand as well. And then we'll go into just answering some questions and whatnot. Okay. Now your earnings growth and your sales growth, right, comes next. You can see here, sales growth and earnings growth has been really good for Seagate. Right, 52% earnings growth, 28.9% sales growth. All right. And then in the end, you have a price to earnings growth right here of a 0.68. What this is telling me is for every 1% in growth, how much am I paying in price? It's the same thing. It's like price to earnings, right? So in this particular case, I'm pretty much paying for about 68% of the growth. I'm not even paying for all of the growth right now. So that's where we know where we got a bit of a discount here. But we would have loved to have seen the price to book and price to free cash flow be a little bit better. Okay. We have our quality of earnings, which measures our free cash flow versus our earnings per share. Right? Dollar for dollar, which means we have $1.01 of free cash flow for every $1 of earnings right now. That's what that means. Last but not least, we have our debt to free cash flow. You can see here it's a 1.73. What did I say we need? We needed, anything below 5, right? What I said is I want to have at least $5 in cash flow, right? Or I want to be able to pay my debts off within 5 years. Let me put it like that. That's a better way of saying it, right? So anything below 5 says I can pay off all of my debt within 5 years using just free cash flow. Okay. Now, let me show you guys what this looks like by hand here, right? Let's go to stockanalysis.com. I'm going to pull up a company called Valero. All right, let's pull up Valero real quick. All right. And so using the same, doing the same process by hand here, right? And I'm still pretty quick at doing it this way because I've been doing this a long time. All right, starting with the F score. We need anything above a 6. You can see right here, the F score is a 6. Okay. Next, we look for that price to book, right? Your price to book is right here. It's a 2.98. Now, what I can do, like I said, is I can go and I can analyze this versus the company's historical ratings here. All right. Here's your price to book right here. You see right now it's a 2.98. Well, in the past, it's been much lower than that, right? You can see that? In the past, it's been lower than that. And while I'm here, I might as well look at the price to free cash flow. It's right here. All right. And you can see in the past, price to free cash flow has been lower as well. Look at all the dates that came before right now, right? This is your current price to free cash flow right here. This is the price to free cash flow of the past. It's clearly been lower than as well. Your price to earnings growth is actually not that bad. Most of the time, you're dealing with price to earnings growth that's higher, right? 5.38 here, 16.16 here, 0.76 here. So the same as with the same as with your Seagate, right? You have those two metrics that are not met, and you have um your price earnings growth that is going just fine. All right, so all that's looked at there. Next thing let's confirm the revenue growth and earnings growth. All right, revenue growth here is a minus 2.78. Okay, so minus 2.78. So in this particular case, the company does not get a in this case, the company does not get a point here either. Now, the company gets 1 point for every single point that it passes. So far, it's passed the return on invested capital, the the F score is past the price to earnings growth. You have a fail on the price to free cash flow and the price to book, all right? And now you got to fail on the revenue growth. So right now, that's what you're looking like here. Okay. Now, let's check the earnings growth really quickly here. Now, we really just want earnings growth to be positive. That's all we want. We just want positive earnings growth, trailing 12 months. Let's find out if we got that. Earnings growth is positive. In fact, it's up 384%, trailing 12 months. Okay. Now, in this particular case, now we are 3 for 3 here. All right. So 3 passed, 3 failed. That gives them a score of right. That means we looked at 6 things already. All right. Now let's go back to the statistics tab. What I'm looking for next is I'm looking for the free cash flow per share right here of $18.70. And if I scroll up, see the earnings per share of $13.75. Now my free cash flow is greater than my earnings per share, which means that in the long run, I'm generating more cash than I even reported in earnings. So that's always a good look. All right, if I generate more cash than I reported in earnings, that's always a good look. All right. Now, that gives me right? A score of 4 out of 7. Okay, let's keep going. I'm looking for my debt to free cash flow right here. It's a 2.07. Anything below 5 is a win. So now I have a score of a 5 out of 8. And the next thing I'm going to look for is the return on invested capital, which is right here. Right? And now my score is going to be a 4.2%. Okay? So, all in all, the company scores a 6 out of it scores 6 out of 9. And so you get an outlook out of that, and we'll talk about the outlook tomorrow. But I want to point something out. In this particular case, we measure the company against its history. But what if the entire industry was experiencing some higher price free cash flow, higher price to book, right, over this time period? That's where the Oracle X comes in really great because it will already have measured that stuff for us. Okay? As you can see down here, it has your benchmarks. So it says here that for the energy sector, right, a price to book of 1.8, a price to free cash flow of 14.37. Right? Now, as long as my price to free cash flow and my earnings growth are less than 2 times the industry, then I should be fine. All right? And you can see here, it's a 3.07. The industry was at 1.8. That means anything below 3.6 is fine. You can see that it's measured here. Right? And then my price to free cash flow is at 13.2. For the industry, it was a 14.37. So this is where the Oracle X excels, right? Is that it's capable of seeing what you may not be able to see unless you did some extensive digging. Okay? It's already set up to handle the heavy lifting, the dirty work. So what it just took me like 5 minutes to do, I just did in like 40 seconds. That's the purpose of the Oracle X. I built this specifically to help people with that. Okay? And so here we are, we have ourselves a strong buy. It would have otherwise been rated as a buy anyway. It would have still been a buy rating with a positive outlook. But a closer look says that it's actually an exceptional outlook. Okay? So, let's talk now. All right? This is how we're able to map stocks out as strong buys, right? Because we have a system, and this system depends on extremely reliable metrics. Okay, so let's keep that in mind. Now, does anybody have any questions or anything they want to, get across now that I've gone through, a few companies here? Anyone?
Yeah, I got a question in regards to book value.
Yes, sir.
Because I always thought book value is basically the value of the company's assets. All the stuff that they have,
Mm-hmm.
and not necessarily its inherent potential. Um, I know with business development companies, and this is because I do a lot of activity with those stuff. One of the major things you look at is the price of with the book value being the loans on their books. But I mean, as far as like another corporation like Verizon, for instance, they spend a lot of money on equipment that becomes obsolete about 10 years, 15 years. when it constantly replacing stuff because the technology is changing. So how would you what how would you use book value as qualifying factor for companies that's constantly going through changing their infrastructure? I guess is the question I'm asking.
Right. That's actually a great question, and it actually opens the door for me to really pinpoint a few things here. Right. Number one, as I mentioned, no one metric stands alone. This is not this is not where we say, let's take this one metric, let's look at it and see what this tells us about the company. No, no. This is let's take this metric along with these other 8 metrics and combine them together to see what they tell us about a company. I didn't say that price to book says anything about the earnings of a company. What price to book tells us next to the Petrosky F score is, are we looking at a business that's currently being ignored? Either way you put it, if I have a company who has any value at all, and they generate a premium return on invested capital, right? And their F score is showing that the company's financials or fundamentals are accelerating, then we're ignoring a quality company. That's where the price to book comes in. It's here to let us know, are we ignoring this company or not? Right? If I have what I can consider to be a reasonably low return on invested, I'm sorry, price to book, right? Then that's my first sign that we're ignoring the company. And then if I can say now that they have the quality, then we're ignoring a quality company. Do you understand that? That's how we use it.
Okay. What's that to play around with right now? My biggest focus is being
Mm-hmm. Even with creating income, doesn't matter what we're looking at, it's the same thing, right? I would rather get income from a quality company, right?
I agree. Definitely.
Right. So either way you put it, I'm gonna look for quality first, and then I'm gonna get what I'm getting from there after. I'm not gonna look for yield first and quality second. Quality first, yield second. All right, that's how I'm gonna always operate.
Good evening.
Good evening. And yes, if you guys want to raise your hand and come to the stage, if you've got questions, come on up. If you want to put them in the channel in the chat on Twitch, I'm looking at the Twitch as well. Go ahead, Mojito. What's up?
Nothing. Just listening and catching up.
Okay, gotcha. No questions?
No questions, sir.
Okay, all right, excellent there. Okay, so there's some things up here, right? And to really dig into the essence of tonight's room, right? Later, Terrence. Really dig into the essence of tonight's room. So you see, when it's all said and done, what we're really looking for, right? We're looking for, as I just said to Christopher, quality at a reasonable price. Now, The first order is to identify quality. That's the first order. What can I say is quality? Our rating system, the investment grade system, is really all about quality and identifying that quality. A strong buy in the investment grade system is the same as saying this is as quality can get. A buy rating is like saying it's quality. Neutral or a hold rating, I should say, is like saying possibly quality, but some things that are in question. And everything below that is like saying, well, not much here is quality at all, if there is even any quality. So those are your sell and your strong sell ratings. Understand that, and this is what makes it amazing when we dig into this. Understand that in order for a company to be rated a sell, in order for a company to be rated a sell, they have to actually fail on these very metrics. They have to be a company who doesn't generate a return. They have to be a company that's not growing. They have to be a company that has a high price on their growth, on their cash flows. A company whose business is not accelerating, it's decelerating. That's what it takes to become a sell or a strong sell in our system. You can see that everything I just said suggests that is a business that I do not want to own. Right? But if the company is accelerating, if I am getting that growth for a reasonable price, if I am seeing growth in the business, if I am seeing returns being generated, if I'm seeing the earnings coverage is stacked with cash, that their debt is well covered with cash. See, all that's the call sign of quality. So it's a call sign of a strong buy. This is in essence how you piece it together. You simply come to the market and you set a prerequisite. You say, I only want what's quality. I only want what I can confirm is likely to perform well over the long run. Remember what I said to you earlier tonight. In the short run, a company, the worst company in the stock market, could go up by 20% in the short run. But it's unlikely to continue that performance over the long run. You take a quality company and you watch them over time, and I promise you, you'll find out that quality, more often than not, tends to lead to performance. Let me show you guys something here. All right. Let me show you guys something here. Let me separate these two views here. All right. Show y'all something here real quick. I'm going to run this report. I just want to show y'all one thing before we close out here. Okay. Now, it is actually analyzing the portfolio that was put together here. Let's open this in a PNG format. All right, here we go. Okay. Yes, you can see here. 74%, guys. We have 50 holdings. We have 50 holdings. Okay. 74%. That's just about 1 out of every 4 investments that we've made are positive in the past year. Now, you let me know if you think that that type of performance can be random. Can that type of performance be a coincidence? Or does there have to be something to it? Right? 74% of these companies. And what's crazy, yo? One of those companies probably had a really bad day with the Fed meeting, right? Because it was 38 earlier, right? Remember that? So one of them probably had themselves a bad day. They were probably trying to get up there and came back down, right? But overall, doesn't matter because I know I can depend on my portfolio to be up 75% of the time. Right? So this is the system that I'm telling you guys about. Right? That book that I told you guys about, the playbook for stock investing. All right. In that link, it's right here. The playbook for stock investing. That book. It teaches the same system that developed this return. The same system we were looking at tonight with the Oracle X. Those two were built to go together, by the way. The Oracle X and the playbook for stock investing, they're built to go together. Right? This actual app that you're looking at right now was built for the playbook for stock investing. So that way the people who read the book could have a tool that they could use and just apply their apply their work. This tool here, this one here, you get this for free. It's something that I give for free. With the book and with the Oracle X, right? Either way, we are doing the next session, which is our session on we have our session on the performance outlook, this side of the grading system tomorrow. And what I'm going to be showing you there is how much weight do we put on these specific metrics? Which ones matter the most? That's what we're going to be talking about, not tomorrow night, Friday, right? Yes, I know Friday is a holiday. If you know, you know. I'm not a days off kind of guy. You know, I mean, I give it a rest on Christmas, but I know at least one Christmas where I was still teaching, you know, but neither here nor there. I might know at least two. I know at least two of those. Alicia, go ahead. You gonna say something?
No, you're right. You're absolutely right. When did you tell us we were going to get the portfolio?
The portfolio tracker? Um, hmm.
On Friday.
I said Saturday.
Thank you, Mo. That's Friday.
I said Friday. You sure I said Friday?
Pretty sure you said Friday.
Cecil, you said yeah?
I want it on Friday, so yes.
You won it on Friday, so I said yes. I will do my best to get it to y'all by Friday. Okay, I'll get y'all in the one. But yeah, so yeah, like I said, I added a financial chopping block here where they use return on equity and price to earnings. So it's actually pretty dope. Pretty dope here. Robinhood needs to drop those price to earnings. I'm telling you, they're on the chopping block.
The fact that we can export our current portfolio, I'm excited about that.
Yeah, you like that part, don't you? Just download your previous portfolio. All right, click on the import bulk and paste it right on in there. You're good to go. All right. And it bring all of it over here for you. All you gotta do is sync it, and then you're good. So excellent stuff. All right. I guess that's it for the night, guys. We had us a nice quick session. All right. 1 hour, 15 minutes. All right. Of study time. So, Atari head game. Appreciate the follow. Much appreciated. Thank you very much. T Motive 800. Shout out for the follow as well. Oh, that must be that Richard. Shout out to Richard for the follow as well. Much appreciated. Again, don't forget that there's that link in the chat where you can get anything that we use tonight. The playbook for stock investing is in there. You see it says stock analysis tool. That's for the tool that I was using tonight to analyze the stocks. And it comes with a free portfolio tracker that you see here, which has all the instructions in it. Also on Saturdays, for those that do subscribe to the Twitch, on Saturdays, I will be hosting sessions, subscriber only sessions that will show you guys how to utilize these tools. I've decided that on those Saturdays, I'm going to have the Division One Clubhouse open, along with the Twitch stream. So you can be in the Division One Clubhouse to ask questions out loud if you want to. Well, I'm going to think about it. We'll think about it because I think a lot of people aren't in there yet. So but I kind of like the chat on Saturdays. What y'all think? Y'all like the chat on Saturdays? I like the chat on Saturdays. All chat Saturdays. Is that what we call it? All chat Saturdays? All chat Saturdays, man. Who just popping up on the stage all late?
Me.
What's up? Gotcha. All right, chat on Saturdays. All right, but yeah, we gonna go all chat on Saturdays, man. Chat needs some love too, right? Chat needs some love too. Chat be getting all neglected during the weekdays. You know.
Correct.
All right, y'all. So I'll catch up with y'all in the AM, and we'll see if this market is up or down. It was recovering a little bit the last time I looked. I'm not sure what it looks like now.
It's supposed to be like a historically, and to the 4th of July bullish.
Gotcha. We'll see it, but
Central. It's on the Trader's Almanac, or whatever that's for. It says that the last week of June going into the 4th of July, like that 2-week period is typically bullish.
Mm-hmm.
Okay. Let's do it.
Appreciate it. All righty, guys. I see y'all in the AM. Everybody be blessed and stay well. Talk to y'all soon.
Thank you.
Bye.
Good night.